Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do the second velocity banking review of the day. Can you believe it? That's what we do here. Why? Because we are the GOATs, the greatest of all time. And if you didn't know, this is actually how I look like according to the Meta AI. I said to the Meta AI, can you please draw the velocity banking GOAT? And this is what the Meta AI came up with, okay? Now, why am I the GOAT of velocity banking according to ChatGPT? See, I'm using AI to kind of tell me what's going on. And ChatGPT said, hey, because you paid off your mortgage in 2 years and 9 months, as you can see right here, you are the GOAT. I am the GOAT. And hey, you know what? You can be the GOAT too by paying off your debt quickly using this thing called velocity banking. And what is velocity banking? All it is a debt payoff strategy where you use your line of credit as your main operating account. That's all it is. If I were to explain it like I were five, it would be dump all money into debt and with the help of a line of credit. Okay. So, what we're going to do is we need two things. Number one is a budget, and then number two is a line of credit as your main operating account. So, we have a budget right here. Now, why do we call this person the average American? And some people were like confused because I've done situations where it's like 16 grand of income, 20 grand. I even did a situation where I did Batman's velocity banking spreadsheet, right? I just added like a bunch of zeros to my other spreadsheets, and it's like this is what would happen if Bruce Wayne was in debt and didn't own the Bank of Gotham, and the Bank of Gotham owned him. Sound pretty cool, right? So, what does the average American mean? Well, it means what's your main operating account. So when you get paid, do you just pay your bills in your checking account and leave whatever's left over into savings as a checking account? Or do we throw every single cent that we have into debt and leave nothing in our checking or savings? Okay, that's all that means with the help of a line of credit. All right, so now what we're going to do is we have to make sure that when we do our budget, we list every single credit card that we have. So we have five credit cards. We got a modest auto loan, maybe a new Toyota Corolla. I don't know. I got a new Toyota Corolla. I think 1 week ago. Has it been 1 week? I still don't even have my license plates. 1 week ago, the new Toyota Corolla, a student loan, right, and a mortgage, and this is the unrealistic part. Nobody's gonna issue you five credit cards, an auto loan, a student loan, a mortgage in one day. But we'll assume these are all fresh new loans for our simulation. And I don't give financial advice, just in case you weren't aware. So don't ask. Okay, so now this is what we're going to do. We're going to do the velocity banking side of this. And the only difference is where's the flow of money going, right? Is it just pay things out of our checking account and leave the rest in our savings? And look at this. We got a cool $20 in our savings account. It's pretty good, right? And remember that study? I don't know if you remember it about the Federal Reserve did a study that, and this was in 2014, that most Americans would struggle coming up with $400 in savings. I wonder if it's gotten better in 2025. Do you think it's gotten better? I remember reading that during 2014 when I was broke. I was like, I'm so broke. What am I doing? And then, like, I was just struggling. I was on the struggle bus. Okay. So, what we're going to do is we're going to do the crazy thing that nobody in American society feels comfortable with, which is having absolutely no savings in our savings or checking account, right? So I'm going to show you that I practice what I preach right here. And if I scroll up, you see money comes into my checking account. You see this deposits. And then when it comes into my checking account, it leaves my checking account as soon as possible. Okay. That's what it does. And where does it go? It goes into my infinity gauntlet, aka my home equity line of credit, if I have some debt on it. Right. And once you get your first home equity line of credit at this amount, man, you can feel the power, right? You could feel the power of that infinity gauntlet. And each of those little infinity gems, they represent what the HELOC can do for you, right? I've actually done, um, actually, let me say this. I've actually asked ChatGPT, like, can you explain velocity banking as in the voice of Thanos? And then every single stone represented what the what the strategy could do for you. It was amazing. The time stone's like, well, the time stone represents how you can pay it off in 5 to 7 years. So we're gonna go ahead and do that. And so what we're gonna do is have an idea called cash flow, which is similar to savings, but it's not, because we can increase this number if we have a line of credit. And what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. That's all a line of credit is. So let's just say I had, I don't know, maybe a 60,000. No, let's do this $80,000 line of credit. Now, what I like to do is just to make the demonstrations easy, is just to make the line of credit amount available similar to all the credit card debt, because it makes the demonstration so easy. But if you want to see a real life case study where someone had a line of credit and it was maxed out, you got to join the 99 cent membership. It's called 22 Debt Elimination Real Life Case Study. So if you want access to that live stream, go ahead and join the YouTube channel membership, only 99 cents. Oh, this is 85 grand. So let's do 90 grand in our line of credit. So the line of credit is a cool tool where I could literally go to the bank's website. I could just go in here, I click a button, okay? I click a button and I can get up to $280,000 into my checking account, just borrowed money at technically 7.5%, even though I signed it at 8%, 7.5% interest. Click a button and bam, I could get $280,000 to my checking account. You can't even do that with credit cards, even though a credit card is technically a line of credit, okay? So this is what we're gonna do. This is what we're gonna do. We're gonna move these credit cards into the line of credit. And so that's, I think, 85,000, right? I have a totally bad memory, so I gotta do this again. But let me go ahead and sum this up. Yeah, 85,000. So let's move 85,000 from the credit card into the line of credit. Okay, 85,000. Now, I'm going to be real with you all. No one's going to give you a free and clear line of credit. No bank will, or credit union, if you say that you're in all this debt and have only $20. Because here's the sacred golden rule when it comes to banks and lending: is banks don't lend money to people who need it. Okay. You ever wonder how I got all this credit? Like, this isn't my only credit line. I have $575,000 in lines of credit. So when I see ads like, "Hey, I could get you $150,000 in credit lines," it's like, bro, not for me, because I got 575,000. 575,000. And why? Because I understood the basic principle that banks don't lend money to people who need it. So if you try to get a credit line here, you're going to struggle. You're going to struggle. Okay. So let's go ahead and do this. And since we move that credit card debt, these all go to zero. And look at that. Look at that. How do we literally go? And I got to zoom up on this so y'all can see $20.34 in savings to 1797 cash flow. And here's the final step. Okay. You put your entire paycheck into the line of credit, and then you take your expenses out, and then you rinse and repeat over and over again. And that's it. And that's it. All right. So now let's go ahead and do this. And what we're going to do is calculate the next month's balance, which is the previous month's balance, the previous month's interest, minus our cash flow, 1797.84. And then what we're going to do is we're going to calculate the interest by taking the average of the daily balances. So we can estimate what this average function right here, get 8%, but it's not just 8%. Okay. So even though the interest rate says 8%, that's annualized 8%. That's the amount of interest you would have to pay if you held that credit line for a year. You would pay 6 grand for borrowing about 80 something thousand dollars. So, but actually, not in, yeah, it would be in a year, but they wouldn't charge you that in a month. Okay. So what we do is, to get the monthly interest, we got to divide by 12. Okay. And so we're not paying as much as we think, although we do have to pay for the credit line. And here's the thing I want to add: for every time we're using this strategy, we got to give ourselves a goat, because we are the greatest of all time. All right. I've added this little goat emoji here. So this is now our mascot, I believe. Okay. All right. Goat, goat, goat. Look at all these goats. And let's see how long it takes for us to pay them off, right? All right, well, all of our little goat soldiers paying off this debt, and how long is it going to take to pay off? Okay. Ooh, 57 months to pay off that credit card debt. Not bad, okay? Considering we only had, actually, I screwed up here. Look at that. So let's do this. Oh, look at that. You know what? It's even better. You know what's really great when you screw up and then your results come out better? That actually happened to me a couple of times. I never in my life would have calculated that I paid off my mortgage in 2 years and 9 months, and somehow here we are. So let's go ahead and re-update our cash flow, and we'll keep the goats, right? So 2847.84. And let me go ahead and copy and paste and see when we actually pay it off. All right, so now we're going to pay it off in month 33. That's even better. Okay. We won't have as much goats, unfortunately, but it's okay. I love you all. You're all the greatest of all time. All right, so now let's go down here. So 33 goats, the greatest of all time. So 33 months, we paid off 85K. Okay. And we literally went from $20 dun 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 to $2,847.84. I really need some sound effects, kind of like the what other YouTubers do. It's like whenever they have like dramatic moments, I gotta have like a producer, but I'm a little bit too poor to afford a producer, even though I paid off a mortgage in 2 years and 9 months. Not that rich. Okay. Right. In fact, if I did what other people did, which is buy a $400,000 house, no way I could have done that. Right. So here's the number one rule when it comes to real estate: always buy at a discount to market value. You buy at a discount, you'll be fine. If you don't buy at a discount, that's the struggle bus. And that's why a lot of people regret buying their homes. Okay. So now that we're done with the credit card debt, again, there's only so many types of debt that we can have, right? Credit cards, personal loans, auto loans, student loans, mortgages, they're all pretty much the same, right? They're just tied to an asset. And usually the auto loan is 5 to 7 years, student loans like 10 years, and the mortgage is 30 years, right? And then if you're a big fan of Dave Ramsey, it would be 15 years. Although, um, I don't know if I'd get a 15-year mortgage. I'd be a little bit nervous about that to get a 15-year mortgage. Yeah. Okay. But I do like the 30-year mortgage that if times are tight, at least you can make the monthly payment, right? But you don't want to just make the monthly payment. And when it comes to a loan, think of the monthly payment as the minimum payment, kind of like a credit card, right? The credit card and the amortized loans, they work the same, okay? But they incentivize you to never pay more than you have to, right? And that's why Dave Ramsey actually is a proponent of the 15-year mortgage, because, like, dude, if you get the 30, we got the statistics, nobody pays it off early, or very few people make the overpayments to the mortgage, okay? So let's go ahead and do this. And where is my loan calculator? All right. So if you want to create your loan calculator, it's pretty cool. I got a link down below somewhere to the loan calculator and the velocity banking calculator. The only thing I can't provide is the Renatus velocity banking calculator, because that's not mine, because it's only for Renatus students, and I'll talk about that a little bit later. But if I type in 33, 33, 33, these are the current balances at 33 months. And why am I going to attack the auto loan first? Because I get more bang for my buck in terms of cash flow. So even though this has a higher interest rate, okay, even though it's a higher interest rate, we're more cash flow focused. So I pay this 11 grand off and I get $460 back in my cash flow. I pay this off quickly and then I tack the student loan. Okay. So that's what we're going to do today. So now I'm going to copy and paste this auto loan and just move it to the line of credit. Let's go ahead and move it into the line of credit. So this is plus 11869.27. And once we pay off that auto loan, guess what? Our cash flow increases by $460.41. So let's go ahead and do that. And now our cash flow is $3,000. OMG. Okay, so let's go ahead and copy and paste values. And then now 3308.25. And now, whoa, I look how quick that was. That was 1, 2, 3, 4 months. Are you kidding me? Are you? Oh man, I love good surprises, don't you? Man, okay, we got 37 goats in the house. Okay, all right. So now let's write in our milestone calculator how many we paid off. So, or how much we paid off. So 37 months equals 85 plus 25. So that's 110K in less than, or actually 3 years in 1 month, 110,000. All right. So now we go to the next one at 37 months, which is our student loan. So where is the student loan? So this is now 0, and then now it's 37, 37. And so now we see we have 26 grand in our student loan balance. Okay. I think it's safe to move this to a line of credit because this interest rate is very similar to the line of credit. Um, but if you want to be really safe, so if there's even a 1% interest rate difference between this and the line of credit, I think still doing what we call the chunking method is the safest bet, right? So if you have an 8% line of credit and you're dealing with loans that are much lower in interest rate, the chunking method is a safe bet. So what do I mean by that? So you just take a piece of the loan, right? It's kind of like chopping it up into little pieces and then just paying it over and over again. Okay, so I'll demonstrate this more with the mortgage, but let's just move the student loan into the line of credit for now, and I'll demonstrate with this mortgage. Even though with the student loan, I wouldn't necessarily do this outright, but let's go ahead and do this. Hey, 26 grand. So it's going to be plus 26676.3. All right, and then now what happens to our cash flow? This goes to 0. And then now this is 3.7 grand. 3.7 grand. And so now I'm going to copy and paste. I'm going to copy and paste right here. And then this is going to be 3714.63. Okay. So how long does it take to pay off that student loan? It takes 45 months. Okay. 45 months. Not bad. Not bad. So 45 months to pay off the 7% student loan. And how much is it? That now that's 145K. No, not 154, 145K. So 35, yep, 45K. Now at 45 months, what's the balance of the mortgage? Okay, it's 192,000. Now, we know from general statistics that most people will never overpay their mortgage. Okay, so if you take a look here, if someone has an extra $3,714, what's the likelihood I'm going to dump all of it into any loan, whether it's an auto loan, student loan, or mortgage? It's very unlikely, right? And why is it so hard for us to do that? It's because the loan is a one-way street. Okay, the loan is a one-way street, and most people, okay, and including me, would have a hard time dumping all of my money into a loan because unlike with the line of credit where I don't have to think about how much I'm putting into the line of credit because it's just my entire paycheck, you have to actually know how much you're putting into the loan. Isn't that weird? Like, I didn't think about that, but when I was doing it in practice, like, wait a minute, this is so much easier when I just move this into the line of credit because I could just dump my entire paycheck in, and maybe I'll have some variable months, but I'm using all of my active income into the line of credit. Now, I know people freak out about this 3% and 8%, right? And I know they do, but let me just show you something, okay? So, a lot of people act like it's the end of the world. And let me just show you this. Let's say you had a 0% interest loan, meaning absolutely no interest was charged after the end of 30 years. And you're like, I still want to use the line of credit for whatever reason. Not that I would do this. I'm just saying this is the worst case scenario. If for whatever reason you did this with a 0% interest line of credit or 0% interest loan, and you were using an 8% line of credit. Okay. So let me go ahead and fill in the deets, aka the details, right? So let me just do this. And if you don't know what this is a velocity banking calculator from Renatus, which is where I originally learned velocity banking from. So if you want to not only learn about velocity banking, but learn about real estate investing, financial literacy, up your game, right? We'll call it that. Click the Google form link below. And full disclosure, I do get money because I am a greedy SOB. And even though I paid off my mortgage in 2 years and 9 months, hey, why not make a little bit more money, right? When Apple is making tons of money, they don't say, hey, let's just stop. They just find ways to make more money, which I'm going to do right now. Hopefully. All right. So let's go ahead and do this and do the worst case scenario. 210, right? So let's say this was actually a 0% loan, 210,000, and interest rate is 0%. And what's the payment here? 583.33. So 583.33. Okay. And let me just go in here. All right. So let me just go in here, which is 6,500 is my income. Okay. And what's my living expenses? It's everything except for the loan I'm trying to pay off. So it's 1,900 right here. All right. So let's say I was, quote, dumb enough. And again, maybe I probably wouldn't do this, right? I don't think I definitely wouldn't do this with the line of credit if somebody gave me a 0% loan. But let's say we did do it. Okay. $7,000, whoopsie, chunks here, $7,000. We move it to the line of credit. That's 8%. What's the worst that can happen? Oh my goodness, I paid this in 3.9 years and I overpaid by 1,400 or $1,500. Okay, like okay, like so when people go from 0 to 8% and they're doing this chunking method, yeah, like it's not the best, but you only overpaid for 1,500, okay? But let me just show you this. If you do a first lien HELOC, you overpay by 41 grand. That's a no bueno. Okay. Now, obviously, this is not a 0% loan. Now, the closer you are the interest rate to the line of credit, the better the result. But even when you have like a small interest rate, right? So let's say we're going to do this, right? What's the payment amount of 3%? 3%. Let me go in here. I'm going to delete this. So it's 3% at 885.37. So 3% at 885.37. Okay. And that's not the current balance. So the current balance is 192,858.69. 192,858.69. Okay. Now, look at this. This is a full replacement. Oh, actually, it's 192,858.69. Full replacement of your mortgage with the line of credit. Look, you paid 34 grand. Okay. But if you just do small chunks, $7,000, look at this, 11 grand, 3.8 years. Look how easy that was. Easy. Okay. So let's go ahead and go back here, 3.8 years to pay off this. So, right. So 45 divided by 12 plus 3.8. And then 7.5 years, we are debt free. Debt free. And let me get the goats here. We got a ton of goats that we're developing, raising, because we are debt free. Look at that. They're all so happy to be in the goat farm, the debt free goat farm. Do you want to be part of the debt free goat farm? Then you can do one of two things. Number one, you can join the YouTube channel membership, 99 cents. Or number two, purchase a Renatus educational package. It costs money. But here's the thing, we give it this velocity banking stuff as kind of like a Costco demo, and it's one of the things you can learn. But don't you want to learn real estate investing, maybe possibly building your wealth, and do cool things like, I don't know, buy a property at $100,000 discount, right? You know how people are like overpaying for properties and they only care about the interest rate and but they don't care that they're what the purchase price is. Folks, we gotta think the opposite of most people. If someone says, "Hey, they got a $300,000 property," we gotta buy it for $200,000. If we have a $200,000 property, we gotta buy it for 100. If someone has a $100,000 property, we gotta buy it for like 5 to 20 grand. You know what I'm saying? So, okay, so that's what we want to do, and we want to be the biggest and the best goat that we can, and we're already there when we're debt free. So with this person, 7.5 years, we're debt free. Okay, 7.5 years. All right. So isn't that easy? And you know what the cool thing is? This is the second debt payoff velocity banking review for the day. I wonder if I can kind of you know, do more in a day, maybe like 10 in a day. That would be insane. Can y'all keep up? I probably can't even keep up. My mind would probably stop paying attention by the third one just because, like, I don't have the willpower to do so. Okay. Well, that's it for today, the second velocity banking review. So hopefully you can be the GOAT of debt payoff in a short amount of time. All right. This is Crane Atlanta Mentorship. Have a great day.